Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly video with our friends at Strategas. This week, we are thrilled to be joined by Managing Director and Head of Fixed Income Research, Tom Tzitzouris. Tom, how are you doing this morning?
Great, and yourself?
Yeah, doing really well. And it's fortuitous to have you today. We have FOMC minutes out later. We'll get a look into what the Fed is thinking about. I wanted to start with that. I wanted to talk about tapering. It's kind of been the key word over the last few months. They've started to kind of hint that they want to do this soon. They've really telegraphed their moves. Do you expect volatility a la a 2013 taper tantrum, or do you think they've done a good enough job to kind of limit any of the big swings? How are you viewing this?
Yeah, definitely. It's not our base case that we're going to see the type of volatility that we saw in 2013 when then Fed Chair Ben Bernanke announced a plan to taper. Part of the reason why we saw so much volatility then was because he did that at perhaps the worst place, the worst possible time in late May at congressional testimony. We don't really see Fed Chair Powell making that same type of mistake. But the other thing about tapering at this point in time, it's been so well telegraphed and so much anticipated by the market that for the most part, the market is now saying, kind of, let's get on with this. Really, what is holding you up? And what we think is holding the Fed up is not the economic data, although publicly the Fed will say that they need to see more data. What we really think is holding them up is that there's concerns that there's going to be another surge of geopolitical risk, both domestically and foreign. And that's really what's holding the Fed up.
I see. That makes a lot of sense. And yeah, you're right. I don't think I've heard that from any of the Fed governors, but it's certainly a headline risk out there. We've seen it this week. Does that affect your outlook for interest rates or inflation at this point, or is it just something to kind of keep an eye on it?
Yeah, it definitely affects the outlook because we'll first focus on the domestic issues, geopolitical issues, and those are debt ceiling, fiscal budget, and for 2022, and stimulus and tax increases. So all of those things will substantially impact not just treasury yields on, say, the 10-year part of the curve, but also Fed policy on the front end of the curve. So as it stands right now, the bond market is staring down a pretty substantial fiscal cliff or reduction in fiscal stimulus for 2022. Until that gets whittled down, and by whittled down, we mean less tax increases and perhaps more spending for next year, you're going to look at the bond market really kind of suppressing long-term bond yields. And that also means the Fed has to be cautious here. And really specifically to the Fed, what we mean is that the Fed can taper and they can announce a plan to taper in the next month and a half or so. But how they communicate that is important because they do not want the market to begin to price in rate hikes for next year or even early 2023. That's a concern because if the market begins to price in rate hikes at the same time you're looking at fiscal drag coming from Congress, then 2022 could end up becoming another lost year where not only does economic growth underperform potential, but you see all of this movement towards a higher inflation regime, which the Fed is targeting right now. That movement towards a higher inflation regime could completely come to a halt, and you see inflation dip right back down. So what they have to do is they have to be cognizant of the fact that fiscal policy is still uncertain, and that means they have to proceed with tapering, but be cautious on how they communicate that so the market does not interpret that to mean rate hikes are coming anytime soon.
Yeah, it's a lot of moving parts right now, right? Fiscal policy, taxes, debt ceiling, tapering. One other moving part that you've written about is the supply crunch that we might see in the treasury market. How do you expect that to influence rates in addition to what looks like a still strong economic outlook, but again, with all those other factors that could come into play in 2022?
Yeah, I think the primary way that this supply crunch that you alluded to is going to affect the rates market is that almost certainly the Treasury is going to reduce the size of its note auctions, particularly 5, 7, 10s, and probably as soon as fourth quarter of this year and throughout the majority of next year, you could see substantial reductions in those auctions. What that should actually serve to do is two things. One, it should encourage more foreign demand to continue to bid at Treasury auctions because there's now no longer this fear that supply is going to run drastically high for a very long time. So there's a little bit of a shortage and a little bit of a more increase in confidence in the US Treasury as a credit. But that also scares away shorts who might have been looking at the enormous supply explosion we saw in the first quarter as just an opportunity to put on and pile on shorts. So what that means is it probably puts a ceiling on how high 5, 7, and 10-year treasury yields can rise, at least this year, and probably a ceiling as far out as early first quarter next year as well. Then the market is probably going to look at this and say, okay, well, we've reached a bit of a trough in issuance, and then the treasury is probably going to pick up issuance again, if not late 2022, then certainly sometime in 2023. But for the near term, the market is looking at this, and this is another reason why you're seeing a ceiling. If we'll focus on 10-year yields, you're seeing a ceiling on 10-year yields probably around 2% for the foreseeable future until we can clear these fiscal issues.
Yeah, like I said, it's a lot of moving parts. It's a lot for investors to take in, and that's why we're glad to chat with you every now and again. So I want to thank you for your time, and hopefully we'll get to chat again soon.
My pleasure. Thank you for having me.